Hey, hi. Thank you for tuning in again. This is Devon, and I am the time value consultant, and I'm going to show you what a mutual fund is. And simply, a mutual fund works by pooling a source or sources of money from multiple investors, such as yourself. Then they invest in the returns on that amongst different securities. So, as a result, by spreading the risk over diversified assets, you thus lower your risk. I'm going to go over a few things, and then maybe I'll touch on these equities, bonds, and golds in a separate video. But essentially, a mutual fund has a more diversified portfolio than a single stock. Take it from me, you can spread that risk out via multiple companies utilizing a professional fund manager. And some of the features and benefits of a mutual fund is that they are regulated, they have professional management, they also have growth and wealth creation, and they are actually safer than owning direct stocks. And one of the ways you can get involved in it is by downloading an app called Acorn, and I'll tell you more about that. So first, let's talk about how they are regulated by the Securities and Exchange Commission. This Securities and Exchange Commission Act was established in 1934, which created the Securities and Exchange Commission. So it gives the SEC authority and control over this industry. So it's highly regulated, starting even from the stocks as a company, they're regulated by them. So this Investment Act of 1940 specifically regulates mutual fund companies, and it focuses on disclosure and objectives of the company structure and its operation, because a mutual fund in itself or company is its own entity. So they regulate that those that are offered in the public market for sale. Now, how it is professionally managed, these guys are pretty smart, Harvard, Yale, Princeton, whatever school they go to. They become money managers, securities. So they invest for you. So they typically do research. They employ various tactics, whether that's public information, hidden information, in order to research the best investments to put inside that portfolio. And also, money managers, the way they make money is they charge a guaranteed fee on that asset of anywhere from 0.5% to 2% annually. And these are structured in by law, so you can't change much of that. Now, getting back to the mutual fund and how it best serves you as far as safer than owning stock direct, it has a lower risk versus a high risk of a stock, where it could go up in a day, go down. It seems stocks like, what was the last one? The movie theater stock that was going on a run. Can't think of it right now, but it'll come to my AMC. That's one of them. Then there was GameStop. So you can see how stocks can run up and it can go down. Typically, you won't have that problem in a mutual fund. Now, there is typically a low cost associated with a mutual fund, because you can get access to multiple companies at a different at that share price. However, there are mutual fund companies out there with very expensive rates that charge exceeding funds. The difference between a stock and a fund, and a mutual fund, again, is the fund manager. Right here, as we see the fund manager, we have a fund manager on here that manages the fund. And with the stocks, there is no fund manager. So you're pretty much out there doing your own. Hey, I can get some Apple, or you can do some research on what a friend is doing. But let's see how that works for you. Now, the tax benefit thing, I'm not too certain about that. We got to look into that. If you buy a stock and don't sell it, you don't have to pay capital gains, and you have to pay capital gains on mutual funds. So let's get to the growth and wealth part of it. So the way a mutual fund differs in a stock is that a stock is not priced at the actual price of that stock or the stocks that underlie it. It is purchased at what they call a net assessed value, or NAV. So that is essentially the unit price of a mutual fund. So they're actually bought and sold at that NAV, unlike the share price of a stock, which change constantly, which we mentioned earlier. And then also the NAV is determined on a daily basis at the end of the closing price. So you don't get that fluctuation on a daily basis like the stock. And those expenses, or which are known as called TERs of a mutual fund, actually determine that NAV at the end of the day after management, administration, and distributions fees have been allocated. So it works a little bit different than a stock. Now, how to access this strategy minus a broker. As I mentioned earlier, there's a company called Acorn. It was founded here in the United States in California. And what they do is do micro investing and robo investing. So it's kind of on the go. You do it through your phone on an app. And the great thing about it is that you don't have to think about it. They have diversified portfolios that vary from aggressive to very less risk, depending on what your risk tolerance is. So they also have automatic rebalancing, automatic investing, and it's on the go. And if you want to sign up, you can click on the app right here, link here, and it'll also be in the link in the description below. And that is how a mutual fund works, and how you can also access that mutual fund via the market without paying a broker. Thank you. Whew.